I just watched David Sachs being interviewed on the Jimmy Dore show, who was explaining and I could have watched him on the Glenn Greenwald show on Rumble.
And you could have paid like $3,000 minimum to get into that fundraiser that he threw for Ro Khanna. Then maybe you could have had an in-person conversation. You might have had to go up to $13,000, as you guys wrote about in the prospect.
Now, just to be fair, David Sachs has no deposits, according to him, in SVB. Now, of course, he does have a lot of companies that he's invested in have deposits there, but that doesn't mean that he would have any interest in any type of bailout.
That gives him no personal
no incentive, none whatsoever. But in the 40-minute interview that I saw, he basically blamed the Fed for this, but because their interest rates were so low that it caused everybody to over leverage and get stuck with bonds that were not valuable and with interest rates that were so low that they were looking for other places to put their money, and that it caused runaway inflation, and that's why the Fed had to raise their rates so much. That was his story. Tell us what the real story is, please.
Well, I mean, the important thing to know about the Silicon Valley Bank collapse and the subsequent actions is that everyone was at fault. And when everyone's at fault, that makes it supremely easy for individual people who were at fault to point to the other person who was at fault to deflect blame. So you can go right on down the line and see failures here at pretty much every level. And I don't know, I almost don't know where to begin, because you could begin at any part of this story.
Well, let's start.
Yeah,
but this is what I think like we should start at, because from my perspective, there is the most upstream cause of this was the rollback. Mm-hmm. I mean, and you tell me if I'm wrong. In other words,
the deregulation.
The deregulation in 2017, 2018. If that doesn't happen, there may be problems at SVB, but they're not allowed to grow, to metastasize like this.
Well, I mean, and you have groups like the Bank Policy Institute, which is a bunch of bank lobbyists, saying that no, actually, the deregulation wouldn't have changed this at all. So, I mean, you have there's contestation going on at every level of this, and finger pointing going on at every level of this. But it is absolutely clear that the 2018 deregulation bill, which I call the Crapo bill because it reflects both its author and its content, Mike Crapo, the senator from Idaho, that bill absolutely was laser targeted at the very regional banks that are experiencing crisis right now. The stadium banks, as I called it, that aren't big enough to be a global systemic financial institution. However, they are big enough to get naming rights to a stadium. These are the banks that are in this wheelhouse right now. And the biggest things in that bill helped those banks. It did two major things. One was increasing the threshold for enhanced prudential regulation from 50 billion in assets to 250 billion in assets. So increasing that threshold, which meant that everyone that was at 47 billion, 50 billion, and didn't want to go over that line because they would get a whole bunch more compliance risk that they would have to deal with, then they can say, oh, now the line's up here. We can keep growing. We can keep eating other community banks.
We can get five times as large.
We can get 5 times as big. And that's exactly what Silicon Valley Bank did. And it's what Signature Bank did. There's that part of it. And then
let me just ask you a question about that, though, because wasn't the theory that, and I think Powell's argument was like, these are not, I don't know exactly the term of art. These banks do not constitute a systemic risk, right? Like they're not big enough to constitute a systemic risk. Right. But if that's the case, why did the country come to a standstill for 3 days? Like, everybody's like this.
Well, and
definitionally, how could that be?
And indeed, to bail out the depositors, they had to invoke a systemic risk exception to the rules because Dodd-Frank kind of banned bailouts, but there was this exception. They had to say, oh, these guys are a systemic risk, and that's why we have to do this. So it completely, refutes their entire point right there. So, yeah, I mean, obviously, we knew this going in. IndyMac was under $250 billion. Continental Illinois in the 80s was under $250 billion. There are all kinds of examples of banks of this size whose failure leads to a systemic problem. And so this was never, and by the way, if it wasn't for several Senate Democrats, this bill would never have happened. Mark Warner, John Tester, Heidi Heitkamp, Joe Donnelly, they co-wrote this with Crapo.
Right.
And they are completely 100% responsible for this happening and are completely unashamed about it, because Warner, even now, is going on television saying that this was a good bill. And Tester is out, doing the blame game, pointing the finger at something else. And we can talk about that something else later. But so the bill did first the raising the threshold. The second thing it did is it invited the Fed to deregulate even further. It changed one word in a statute, a statute known as the tailoring rule. And this rule says that the Federal Reserve has the ability to tailor rules to what they see as the risk involved with that bank. And they changed that from the Fed may tailor rules to the Fed shall tailor rules. That's all they did. They changed one word. That shall triggered a process where the Fed had to undergo this look at all these banks of a particular size and then see if they were going to change the rules. And that's exactly what they did in 2019. They tailored the rules to weaken them even further on the stadium banks, on the banks between $100 and $250 billion. Lael Brainerd, who is now the head of the National Economic Council, came out and said, this is a really bad idea. This is kind of stunning to see a dissent at the Fed at all. And she came out, she was a Fed governor at the time, and said, this is a really bad idea. This is going to increase risk in the system. This is going to increase financial instability, and this is going to make it more likely that there will be taxpayer bailouts. And that's exactly what happened. That's exactly what happened. And
that's why she's now nominated to be the chair of the Fed, right? Because she clearly understood what the implications of this would be, and that is being rewarded by our system.
Right. Well, what we know is that the Fed doesn't give a crap about financial regulation or supervision at all. They see it as secondary to their macroeconomic policy role, when in fact what we learned this week is that it's central and inextricable from their macroeconomic policy role. And now we can start talking about the Fed in this, because not only did they roll back some of these rules, which was discretionary, it was discretionary deregulation what they did. They had the opportunity, they had to look to tailor the rules, but they didn't have to do it the exact way they did. And what they did is they went in the most deregulatory direction. So not only did they do that, but the primary supervisor of Silicon Valley Bank was the Federal Reserve. They were the regulator. They had the examiners, specifically the San Francisco Federal Reserve, the regional bank, which is part of the main central bank. Their examiners were the ones looking at Silicon Valley Bank. By the way, the CEO of Silicon Valley Bank was a director of the San Francisco Federal Reserve until Friday, until a week ago.
Interesting.
When suddenly on the website it says vacant under his name. So so what we learned today, there was a Bloomberg piece, San Francisco Fed trying to cover their ass. They put out this thing that says, oh, well, we sent them what are known as matters requiring attention. We saw that the bank had this interest rate risk because they put all their money, or a lot of their money, into long dated securities did well at low interest rates. And when the interest rates went up, the value of those securities went down. They didn't hedge that risk in any way. They tried to keep it in the hold for maturity on their books. In other words, they didn't want to realize those losses. They had these massive unrealized losses on their balance sheet. And then the bank also had this huge flight risk because most of their deposits were over $250,000. All of them came from the same industry of people who are on Slack with one another. So they didn't have 30,000 depositors. They had like 9 because it was just a bunch of people in VC chats with one another. And so they had this huge flight risk on one side, which would make them realize these losses, and these huge unrealized losses on the other side, which they were trying to skate around. But if as soon as there was any trouble at the bank and any kind of loss of deposits, they would have to realize those losses. And the San Francisco Fed, according to them in this story in Bloomberg, knew this and sent them these stern letters that said, you might want to take a look at this. You have no risk management on your interest rate. This is basic banking 101. You haven't accounted for the potential change in interest rates. And the bank did nothing. And the San Francisco Fed didn't follow up. They just sent letters.
Well, wasn't that because they are so woke because they're from San Francisco? Right?
It could be.
And they're infected with wokeness. And so they don't want to offend the bank in that instance. But
so
let me
here's what we have.
And just to be clear.
Here's what we have, just
okay, go.
So I can just lay this all out. The bank has no risk management whatsoever. They didn't have a chief risk officer for 8 months. They had a really a time bomb portfolio, and they didn't change it. The supervisors didn't make them change it, didn't ask them to do anything out of the ordinary, gave them, sent a few letters, but did nothing beyond that to actually follow up. So they're at fault. The reason that these enhanced rules were put in under Dodd-Frank is because they knew that the examiners don't really do anything, and the enhanced rules would have forced much more stringent regulation. It would said, we're going to look at your liquidity on a weekly basis, on a monthly basis, on a daily basis in some cases. We're going to force you into these stress tests. We're going to not allow you to opt out of things that would have forced you to put those unrealized losses into your capital rules. There were all kinds of rules that were put in there. The Fed and Congress got rid of them. So you have Congress being the problem. You have the Fed at the top level being the problem. You have the San Francisco Fed being the problem. You have Silicon Valley Bank being a problem. And you have depositors that are such dumbasses that they have millions, hundreds of millions of dollars sitting in a bank that it's
only insures 250. Yeah.
And it's public knowledge that they have a problem. There was a guy who was a short seller who was pointing this out months and months ago. And there was a story in the Wall Street Journal like half a year ago. And it's basic cash management of any business to not put all of your money in a place where you could lose it.
Okay. All right. So listen, on that point, there's two things that it seemed to me. One is that there are obvious mechanisms in which to protect that if you're a business. You got payroll. Your payroll is, let's say, I don't know, $1 million a month or something like that. There are third parties that essentially orchestrate your spreading of the cash around to different facilities, so it's all insured. And
cash sweep, and it's been around for decades and decades and decades. And anything above that amount that covers payroll and other expenses on a short-term basis, why are you in a zero interest-bearing bank account? Put it into a security. What are you doing?
Right.
You're ruining it. Like your
so here's the
duty to actually maximize your earnings is obliterated by that. Like Roku should have lost that money. Bottom line, they were stupid.
Well, wait a second. Now, were they stupid Well, I mean, they were
Yes.
stupid. Well, they were stupid.
Yes.
But
Well, they were
was
penny
there
wise
also
and pound.
was there also like
published.
was there kickbacks here?
Yes.
Like, I mean, that's the other thing.
Well,
is that,
by the
you know-
way, there's a whole other part of this where Silicon Valley Bank actually had the cash sweep ability. It's on their website. It's advertised like you can do this to minimize your risk, and only a very small portion of their deposits actually took advantage of the opportunity. And I've been told a couple things by a couple different people. One is that the bank said that, only some people can access this, and we're getting around to making a change so everybody can access it, and then they never did. I've been told that VCs essentially told the companies, you have to bank and put all your money in this bank, and you can't move it around or do anything else. And in exchange, founders and VCs would get sweetheart deals, zero interest
that's what I'm
loans,
saying. It's
low rate
kickback. That's a
mortgages.
kickback, isn't it?
There's corruption in here too, and I hope that does come out even further. But I mean, we already know about some of that stuff. First Republic, which is this other bank that's in trouble, they got a big cash infusion from the big banks of $30 billion, kind of a private rescue. They gave a below rate interest mortgage to Mark Zuckerberg as if he needed it, right? This is apparently in the tech world. This was like a quid pro quo.
I don't think it's just in the tech world. I don't think it's just in the tech world. I mean, I think there's instances where you put money in
there
in
was
accounts.
The Friends of Angelo thing with Countrywide way back in the day. They would have, Chris Dodd got a cheap mortgage with Countrywide. I mean, yes, this stuff goes on.
You put enough money.
Part of this,
those VC, they weren't getting cheap mortgages. They were getting 0% mortgages.
Yeah.
That's what they were getting. You make sure you join the Diamond Club by making sure that we got $250 million, out of your companies in your portfolio, and we'll give you a $10 million loan, 0% interest.
Right. And then the other thing is that Silicon Valley Bank was essentially investing in a lot of these companies on the side. So they were taking these deposits and then investing back into these companies in a way that was supposed to be prohibited by the Volcker rule, which was this thing about using depositor money to make risky trades.
Right.
Investing in high risk startups, it certainly would have been covered by the Volcker rule, but they got an exemption to that they also lobbied for. So there was a lot going on here with respect to the bank. But I don't think these depositors, these whiny VC idiots that think that they now have to reinvent insured cash sweeps or these kinds of things that get around the FDIC limits when they've already existed, much like when Uber and Lyft reinvented the bus, is just absolutely absurd.
But do you think that they think that you need to reinvent sweeps, or do you think that they're pretending that there's a problem here to justify having that kind of money in the bank unprotected because it was in the interest of the bank for them to do that, and they were getting kickbacks in the form of like sweetheart loans and stuff like that?
At first, I thought they were lying, but they're doing an increbly good job of looking like dumb shits.
They're doing this is the classic stupid or evil debate, and I'm not convinced it has to be mutually exclusive.
It doesn't, but they're doing a fantastic job of looking like idiots.
When I see David Sachs going every single place he can go to get out the word that he was not, that he has, that it's not a question of regulation, and we need to fix the system so that people can do their payroll out of one bank. Like what?
Yeah, the goal of all this, from the perspective of the people who got the billions of dollars in government largesse, and by the way, not just at Silicon Valley Bank, but it's really much more important for the banks that didn't fail, that were on the precipice, because now they have access to a loan facility where they can put in all that stuff that they had losses on, all those long dated securities. They can get it for a year, get a loan from the Federal Reserve at par. In other words, this is worth X amount of dollars now, but we'll give you the face value, which was much higher, and we'll give it to you as a loan. That's your collateral. Those are the people who got the real bailout. I mean, that's the one that nobody wants to talk about. But anyway, my point
and just to be clear, I just want people to understand it because you're going to hear mark to market. When if I've got a like a some type of bond that I got that a 5-year bond, let's just say at 3% when interest rates were low, and now it's not terribly valuable. It's worth a lot less than I paid for it because nobody wants to be stuck in for 5 years in something that's only going to give them 3% when I can go to a commercial, a retail bank and get a 4% a CD for 15 months right now. The mark to market means like how much would you get if you sold that security to someone who know they're only going to get 3%? It's secure, but like it's only going to get 3%. You're going to be losing against inflation. Right. So the value of that is low. That's mark to market. Par is what I paid for it and anticipated what the value would be.
Right, that's right, and so it's a massive backdoor bailout, and it's mostly to the banks that were going to fail in the future and now will not because they now have a rescue program in place, and that's a bailout to their shareholders, that's a bailout to their executives, and that's a bailout to their bondholders, which is exactly what was said was we're not going to ever do again.